Inflation in Canada remained unchanged in November at an annual pace of 3.1%, higher than the 2.9% expected by economists. StatsCan says Canadians continued to feel the impact of higher prices for mortgage interest costs, food purchases, and rent, the largest contributors to inflation in November. For perspective, let's go to Beata Caranci, chief economist at TD Bank. Beata, thank you very much for joining us. Your overall reaction to these numbers. This has got to be a disappointment to the Bank of Canada.
Yeah, a little bit of a disappointment. It's definitely in alignment with what Tip Macklin's been talking about the stickiness of inflation and specific components like food and shelter in particular. And it also helps reinforce why on Friday of last week we didn't get the same tone out of the Bank of Canada that we're getting out of the Federal Reserve, who's showing more comfort around the direction of their inflation numbers, whereas the Bank of Canada still shows a little bit discomfort whether, the trajectory for inflation is in fact moving towards 2%. So still a little bit of a road ahead of us. It could be worse. It could have backed up a lot more. It didn't. It's, these core metrics are holding at around 3.5%. It's got to break below 2% before they start cutting.
We saw immediate reaction in the overnight index swaps market in Canada. That's the market that essentially forecasts when market participants think rate hikes are coming. That market is now pricing in an April rate cut from the Bank of Canada, as opposed to the earlier forecast of that market of a March rate cut. Do you believe that these numbers today push out the first rate cut from the Bank of Canada?
Yeah, our forecast has always had April, so we're going to stick with that view as the timing of the first rate cut. We still think the Bank of Canada will be in a position to cut by about 150 basis points in 2024, a little bit more than the markets have priced in. They've priced in about 125 basis points for the year as a whole. 25 here or there won't really matter. And the logic is because the economy has weakened quite substantially in Canada, nothing like you're seeing in the US. Canada is quite unique on this front. And that should mean that the inflation numbers are going to have to break below that 3% level as that excess supply continues to build up in the economy. So that's the logic. We need the numbers to prove it, and we need them to prove it in the next basically 3 data reports. So if it doesn't come through, then we're going to have to reassess. But at this point, I think April is a reasonable timing.
How many rate cuts and how much of a total reduction to the Bank of Canada overnight rate are you forecasting for 2024?
So by the end of next year, we think we'll be at 3.5%. So that's 150 basis points in cuts, which amounts to basically 6 cuts. Typically, when you're in an inflation environment like this, where it's not coming down strong and convincingly, we think the Bank of Canada will be cautious. So moving in only 25 basis point increments. On the way up, they were moving at 50 and 100 basis point increments. We don't think that's what's going to, come through on the way down. It'll be more gradual. If it's going to come down faster, it's definitely going to require a harder landing on the economy. So this would be more formal recession dynamics coming through, which would prompt them to cut more quickly than we're expecting. Right now, that is not the view. We think that Canada will have a flat to down economy next year, perhaps in the mild recession camp. And that's why we're using the moderate rate cuts in the forecast. And you probably don't want a faster rate cut cycle, because if you do, that means you're in a harder landing situation.
Does mild recession equal soft landing?
Pretty much. These are being used interchangeably. If you look across the street and analysts forecast, everybody has a rising unemployment rate. For us, it rises to 6.7% at our peak level next year. And so there will be some losses in jobs, but also a lot of that rise is coming off the fact that the labor force growth is just too fast relative to what employers are currently able to absorb. So it's not necessarily all coming off of job losses. And so this is what's defining the narrative of soft landing or mild recession. A hard landing, typically you would be looking at, 20, 30,000 job losses a month. you would probably be looking at an unemployment rate 7.5%, so a little bit higher than what we're predicting.
What do we make of the fact that if you strip out mortgage interest cost, you get a November annualized pace of inflation very, very close to the 2% target of the Bank of Canada? If you strip out mortgage interest cost, you get a pace of inflation of 2.2% in November.
Yeah. Yeah, and if you strip out all of shelter, I think you're at 1.9%. You're sub 2% of that. Yeah, and this is what a lot of analysts have been pointing out, that with the policy rate sitting at 5%, and Tiff Macklin has mentioned this as well, that it's definitely in restrictive territory. It's definitely in a territory that is going to continue to weigh down the economy and slow it down. They are not, so, you know, the central bank could, if they choose, at some point, pivot their language to say, listen, we know we have a supply side shock happening in shelter. It's not demand driven. And so therefore, we're going to put focus on the remaining price components in the CPI basket. And as you pointed out, those are behaving better than what those shelter costs are doing. If they were to pivot their language in that way, it's possible they could cut even earlier than we're expecting in April, but they have shown no inclination to do that. They are sticking with their main metrics, which are those trimmed CPI, core CPI, median CPI. And TRIM does take off shelter components, right? It takes off the highest growing components as well as, you know, the bottom 20% of the slowest. It doesn't take off all of shelter though. So shelter is still part of that TRIM metric. But as it is for now, this is not this is a metric that analysts are citing to point out like, hey, maybe it's not as pervasive a problem as we think, but this is not where the Bank of Canada's mindset is.
But what do we make of the critics say that the bank has contributed to that corner of the inflation picture, which is an influential corner now, mortgage costs, because variable rate mortgages are directly tied to the Bank of Canada rate?
Yeah, and that's one component that's rising over 20%, you're correct. However, rent is rising by 7%, and they don't contribute to that, right? So there's many, and even other factors on household operations are still rising at a high rate. So there's many components within shelter that they're not directly contributing outside of mortgage interest costs. That they're not contributing to, that are still showing that they're elevated, and those are supply side. There's also food costs that are, again, they're not contributing to, that's also rising at about 5%. Car maintenance costs are rising at, I think, 5-6%. Those are high. So there are components that are still elevated outside of shelter, which is what they're putting their focus on right now. If it was only mortgage interest costs, I think we might get a different tone out of them, but it's not.
Beata, thank you very much for this conversation, helping us understand those important numbers released this morning. Beata Caranci is Chief Economist at Toronto Dominion Bank.